In this session, let's look at pricing of derivatives and especially options. One of the most important and most complex kind of derivative instrument, right? So we'll use different kinds of mechanisms to find the values of the option and how we compare it with the market prices and few other aspects relating to the pricing of the derivatives. So this is what we would cover in this session. We'll have a brief introduction to what are derivatives and what are options per se. Then we'll talk about two major models for valuing the options or finding the price of the options. We'll bring in a Black-Scholes model, and we'll also talk about a Cox-Ross-Rubinstein model, otherwise called as the binomial tree model. So we'll talk about two different models. Conceptually, we'll have an understanding of both of them, and along with that we would also use R to really execute both the binomial tree model, which is the CRR model, as well as the Black-Scholes model in R. Then we will also spend some time to try to understand what is the kind of connection between the models, right? We'll try to demonstrate using the R functions, how and when these two models come closer to each other, and as an extension we will talk about the Greek letters, which are the measures of sensitivities of the option. Very interesting aspect, sensitivity of the option. Okay, how does the option premium or option price change when the stock price changes, or when the volatility changes, or when the time to maturity changes. So we'll try to have some kind of understanding on how we compute the Greeks and what is the importance of each of these Greeks on the price of the option. And towards the end we'll spend some time in terms of implied volatility concept and try to generate the implied volatility based on some stocks, based on the options associated with some stocks, and we would also try to generate what we call as the volatility smile, right? So let's try to understand all these aspects both from a technical understanding perspective as well as implementation of the same in R, right? Okay, so just getting into a basic introduction to the world of derivatives. The definition says they are financial instruments which derive their value from the value of the underlying. So we have a stock as an underlying, we have a bond as an underlying, we can have currency as an underlying. So there could be various asset classes which are the underlyings. And when I say derivative, it's another instrument whose value is typically derived from the value of the underlyings. So derivative is not an independent product, its value is derived from the value of another existing product. And we also know that there are majorly four forms of derivatives: the forwards, the futures, the swaps, and the options. So here the intention is not to talk too much about the forwards, futures, and swaps. In this session our focus is more in terms of options, and they are different from the rest, right? In all the three, just as a quick summary, in all these three, both the parties A and B, they get into a contract saying A will buy something from B and B will sell something to A at some future date, but the price, quality, quantity, everything is fixed today, right? And in this case, both the parties, they have to adhere to the contract. They cannot break the contract. Whereas it is that option where one of the parties is actually taking an option to decide whether they want to go ahead with the contract or they want to get out of the contract. So this is where we are saying, in case of options, we cannot be sure whether the transaction will take place or not. When I am saying transaction, buying or selling the underlying. So whether it will take place or not, there is some kind of uncertainty regarding that, because one of the parties, either the buyer or the seller, will have an option to either go ahead with the contract or get out of the contract. So because of this kind of an asymmetric behavior, why asymmetric behavior? One of the parties only it is mandatory to adhere to the contract, whereas the second party can very well decide whether they want to get into the contract, whether they want to continue with the contract or whether they want to exit out of the contract. So only for one party it is mandatory to adhere, whereas for the other party it is more and more optional. So that's where I am talking about an asymmetric kind of a stuff, whereas this kind of an asymmetry does not exist in forward, futures and swaps. Both the parties who got into a contract will have to adhere to the contract. So keeping that in mind, how to model this kind of an asymmetric behavior or non-linear behavior, right? It's not a possibility of unlimited loss or unlimited gain. There is a chance that one of the parties might cap their loss, whereas they can get unlimited gain. So this is what we are talking about, a non-linear behavior. Option is the only instrument where a non-linear behavior exists. So this is where there are different kinds of models which are typically employed to do the pricing of the option. When I say pricing, because one party is typically taking an option to decide at a later point whether he wants to continue with the contract or he wants to exit out of the contract, that party who wants to take the option will make some kind of a premium payment to the other party, so that the other party is giving this party an option, right? So if A wants to take the option, A will pay a premium to B in the beginning of the contract. So that extra payment that is done by A to B is primarily towards B giving a extra facility to A to decide whether he wants to go ahead with the contract or expire the contract, because here B does not have the option. B is obligated, whereas B is giving an option to A by taking a premium in the beginning. So this is where we talk about a non-linear behavior, and whatever this amount A is paying to B to get that additional option is what we call as the option price or the option premium. So whenever we use the word option premium or option price, it is that particular amount which one party is paying to the other party at the beginning of the contract, so that by paying so, this party is taking an additional option to decide whether they want to go ahead with the contract or expire the contract at a later date. So there are two kinds of models which are typically in use. One being the Black-Scholes model, which works as a continuous process, assumes that the underlying prices changes continuously. Whereas the CRR model, Cox-Ross-Rubinstein model, or the binomial tree model, it assumes that the stock prices or any kind of security prices, they are more discrete in nature. They change at discrete intervals of time. So let's look at both of them. Let's try to find the value of the option or the price of the option in both the cases, see what kind of differences both these models are typically bringing in. So theoretically, to talk a little bit about the Black-Scholes model, it is a direct formula. It is based on the following assumption. It assumes that the underlying asset follows a geometric Brownian motion. Right? One major assumption theoretically. It assumes the price of the underlying asset follows a geometric Brownian motion. What does that mean? A change in the price, right? S2 minus S1, the change in price is primarily modeled like this. Some mean times the original price times the change in time. So if I am talking about let's say 1 day, what is on an average the mean change in price per day multiplied by the original price multiplied by the time period, 1 day, plus sigma is the volatility, S again being the price, and W is a Wiener process. A Wiener process is nothing but the values follow a normal distribution with a mean 0 and a variance equal to T, which is the time period. So this is what we are typically calling as a Wiener process. So what it says is the price of an underlying asset, it follows a geometric Brownian motion. Only if the price follows a geometric Brownian motion, then only the Black-Scholes model is applicable. And if the price does not follow a geometric Brownian motion, then this Black-Scholes model will have its own set of limitations. Right? So that's one more thing we have to be comfortable with. The Black-Scholes model is more and more applicable if the stock price is following a geometric Brownian motion. And here mu is called as the drift, which is on an average what is the change in the value of S, and sigma is called as the volatility. So here if you see, these two are constant, they are not functions of time or they are not functions of underlying whatever. Mean and volatility, which are the drift and the volatility, they are constants, and W is a standard Wiener process. So standard Wiener process comes with this kind of notation, and it says the market is arbitrage free. There are no arbitrage opportunities. If it is overpriced, there will be a lot of buying, which will make the if it is already overpriced, there will be a lot of selling, which will bring down the price. If the price of the security is underpriced, there will be a lot of buying, which will pull up the price. And this happens in very no time, which means there is no way to typically create a no risk profit. So that is where we are saying the market is arbitrage free. So the arbitrage opportunities where you can exploit, they literally are not present in the markets. Here this model is more and more applicable if the underlying does not pay any dividend. Right? If the, of course, at later point there have been some modifications that have come out which try to handle if the dividends have been paid or if the dividends are paid by the company, but the base model of Black-Scholes is created under the assumption that the underlying does not pay any kind of dividend. And another assumption, the buying and selling the underlying can be possible in any amounts, even if it is in fractions, which is away from reality. I can buy 0.2 shares of a particular stock as per the model, but in reality that is typically not possible. So there are some kind of limitations and there are some assumptions this model has used to come out with the formula. But yes, we have to understand the assumptions, because whenever we see in reality the stock, the option prices differing from our calculated values, we need to know what assumption out of these is violated. Right? In some cases the stock prices may not follow a geometric Brownian motion, they may follow something else. Or even in reality the drift and volatility are not constant. We'll see later that the volatility need not be constant, whereas here the model is assuming that the volatility is constant. And similarly the market is arbitrage free. In some cases the arbitrage opportunities do exist, and buying and selling typically not possible in any unlimited amounts. right? It can't be in fractions. And stocks do keep paying dividend. There are transaction costs, but this model assumes that the transaction costs can be ignored. And another major assumption that this model makes is the short-term interest rate R. It is known and it is constant over time. So even if I am talking about a 2-year period, it says that the short-term interest rate is constant, but in reality that is not the case. So the interest rates keep changing with time, so it may not be constant at all, which means it is very possible that this model is more and more appropriate for short-term options, where in very short term there is a very small chance that the interest rate will change drastically. But in a longer term period, I can very well say that the interest rate can keep changing, right? So this is where the Black-Scholes model has been developed with all these set of assumptions, right? But still, even though all these assumptions have their own limitations in the real world, we see even today the Black-Scholes model is one of the premium models for valuing the options in the industry. Now, based on this, let's look at what it goes into pricing a European call option. So based on all these assumptions, the Black-Scholes model works out to this kind of a formula to come out with the price of a European call option. It says the current stock price times cumulative distribution value associated with the standard normal distribution corresponding to the value D1, and D1 is computed through this kind of a formula. Similarly, minus x e power minus rt, which is the present value of x, e to the power of minus r, t minus t is the time to maturity of the option. So which means x e power minus rt minus t is nothing but the present value of the strike price. So it is like spot price times ND1. ND1 is nothing but cumulative distribution function of the standard normal distribution corresponding to D1 minus the present value of the strike price times ND2. And D1 and D2 are calculated through this kind of a model, and X is the strike price of the option. So based on this, it's a straightforward formula assuming all these things are met. Of course, we don't need to get into the derivation of this formula, but under the assumption that all these assumptions are met, the Black-Scholes formula typically comes out in this way for pricing the call option, and for the put option it works out to be this. Of course, when we are working with R, we really don't need to remember the formulas because there are functions which already take care of doing these kind of computation, but we need to understand it so that we can assess the relationships, we can assess the basic assumptions that have gone into the computation of the formula, so that if there is a wide deviation between the actual market prices and our computed formula prices, we will be in a position to understand what is the gap. So now let's look at doing this entire thing in R. So for that, I'm talking about a call and a put option on the Infosys stock. Let's take the Infosys stocks as on today, which is 25th June 2016. So let me take that data. So I'll get this prices from Nifty or NSE, National Stock Exchange. So I'll look at the equity derivatives. Okay, let me get it. Let me get the current price. Let me go to Infosys. Okay, so I'm looking at the Infosys stock as of today, 25th June 2016. The current stock price is 1191.2. That is what I think I have written. The underlying stock price is 1191.20 Indian rupees. I am talking about an expiration date for this option. Let me take the expiration date as 28th July 2016. Right, this option expires on 28th July 2016. So I am looking at, so these are the different kinds of strike prices, which means the price at which we are agreeing to buy or sell on 28th July 2016. So let me consider this option. Right, let me consider this option particularly. We are talking about a strike price of 1200. So on 28th July, I want to get into a contract which says I want to buy a share of Infosys on 28th July at 1200. So this is the kind of an option I want to get in. Right? If I'm saying I want to go for a call option, it means that I'm interested in buying one share of Infosys at 1200 rupees on 28th July 2016, and that I want to decide today. I mean, the price I have fixed today, the deal I am entering in today. So whether I have to buy it or not, I'll decide on 28th July. If I want to buy it, I'll buy it at 1200. If I don't want, I can expire it. That is what we are calling as an option. Similarly, when I say a put option, it's like I want to sell one share of Infosys at 1200 bucks on 28th July 16. And that contract I am getting on 25th June 16. So again, this gives me to really decide whether I want to sell one share of Infosys on 28th July 16 at 1200 or not. If I want to sell it, I'll sell it. Otherwise, I'll expire it. So I'm getting an option depending on whether I'm taking a call option or a put option. I'm getting an option either to buy the share or sell the share on 28th July. But the decision but the option I am buying on 25th June. So I have to make some kind of a premium payment to the other party, because the other party is typically giving me a right to decide at a later point, and that other party will not have this kind of an option. So this is where we are talking about how much premium should one party pay to the other to typically take advantage of this option. And a few more important things that go into this decision. What is the volatility? So where do I get the volatility? I can either do a historical computation, or there is a way where I can get the volatility. NSE typically publishes on a daily basis the volatility of different securities. So I'll go to all the day end reports where they publish what is called as a daily volatility. So I can very well download the daily volatility. Right, I have downloaded this daily volatility, and I can check for each stock what is that volatility number. Though I can very well do the computation myself, but because it is published by NSE, I can really, for each of the stocks that are there on the exchange, for almost 1600 stocks, it typically publishes the volatility. So I can go to Infosys and then check the volatility. So the annualized volatility looks like 24.07%. So I can very well consider the volatility as 24.07%. Right, I have rounded it up as 24, but probably I can very well take as 24.07%. That is what has been mentioned. Then the risk-free rate I can typically take from the treasury bill rate. Right, the treasury bill rate I get from RBI, the Reserve Bank of India. So I say rbi.org.in, which contains the treasury rates treasury bill rates associated with India. So I am taking the 91-day treasury bill rate, which works out to 6.77%. I have rounded it up to 2 decimals. So based on, so what all information does it require? In R, if I have to really compute, or even using this formula, if I have to really compute the price of the option, there are 5 major things that I really require. One is the current stock price, current spot price. So in this case, it is 1191.2. I want to know the strike price denoted by X, which is the price at which the buying or selling will happen at a later date. Then what is the type of the option? Is it a call or a put? So which means if it is a call, I'll buy at 1200 at a future date. If it is a put, I'll sell at 1200 at a future date. One share of Infosys. So that's where I need to know whether the option is a call or a put. Then I also need to know the annual volatility of the underlying stock, which is Infosys here, 24%. The risk-free rate of return, which we'll take as 6.77%. And I also need to know the time to maturity. So I can very well take it as the time period between this date today and the maturity date, right? I can very well compute the time to maturity, right? Either I can take it in terms of calendar days or in terms of trading days, but it would be better if I am more and more consistent, right? Trading days is more and more ideal, but otherwise I can even consider the calendar days as a kind of a quick proxy to the trading days, right? So I have to mention the time period in terms of years. So I can find out what is the difference between the two dates, and based on that I can find out, I can convert it into years. So these will form the input. And along with that, if there are no dividends, we also need to mention something called cost of carry, which is what is the cost it takes to which makes you indifferent between today versus 28th July 16. In many cases, if there are no dividends, you can very well take it the same as the risk-free rate of return, right? So as the Black-Scholes model anyhow assumes that there are no dividends. So in case of a Black-Scholes model, the B always is same as the risk-free rate of return itself. So this, once you have this data with you, then finding out the Black-Scholes option price is a straightforward thing. You have the Black-Scholes GBS option. It's the name of the function, which can give you the pricing as per the Black-Scholes formula. So it takes some input, right? The type flag, you have to set it to either C or P. So it says whether it is a call option or a put option. You have to give the value of S, you have to give the value of X, the strike price, the time, which is the time to maturity in years. You have to give the risk-free rate of return, you have to give the volatility of the stock, and you also need to give the cost of carry, which is equivalent to the risk-free rate of return itself. So let's try to execute that in R and find out what is the price of the call option or what is the price of that put option. So let me start R first. So first thing is I require F options package. So let me see if it is there on my system. It should be there, but otherwise you have to first install the F options package, and after that you have to load it using the library. So in my case it's already there, so it is loading the F options package. Now once this package is there, I can simply use the, if you want to see what contains the GBS option, what is it doing, right? I can do a question mark GBS option. It is clearly telling me it's a collection and description of the function to evaluate plain vanilla option. So if I want to find out the value of the plain vanilla options, I can use this GBS option. So there is a generalized Black-Scholes option pricing model, right? We can use it for options on futures and all the other stuff. So you can really go and explore. So if I'm saying Black-Scholes option, it's for GBS option. But if I want for options on futures and all, I have a few other variants of that, right? You could see, or I can go for options on commodity futures. I can use Milterson-Schwarz option, right? I can use a couple of others, but at the same time, if I'm using the Black-Scholes option, it is as good as I can use a GBS option itself. So let's try using the Black-Scholes option from this formula. Let's use the GBS option. So let me say I want to use the GBS option, for which first thing I have to look at is I want to do a type flag. Okay, I'll do a type flag equal to, here I can set it either to C or P depending on whether I want the call option or a put option. Then I have to specify my current spot price. For my numerical, the spot price works out to 1191.20. So this is the spot price. I have to specify the strike price. So we are going with 1200 as the strike price. I have to give the time to maturity. Okay. So I need to really find out what is the time to maturity. So 25th June 2016 and 28th July 2016. So if I quickly look at the number of calendar days, just to make a quick approximation, it is 33 days. So I'll take it as 33 by 365, right? I'm taking the time to maturity as 33 by 365. Then I have to give my risk-free rate of return, R, which is 0.0677. I'll give it in terms of decimal, 6.77%. I'll make it as 0.0677. I have to specify the value of sigma. Sigma is, we have got it as 24.07%. So I'll take it as 0.2407. And finally, I also need to give B, which is same as the risk-free rate of return. The cost of carry is same as the risk-free rate of return in case there are no dividends. So I'll take it as 0.0677 itself. That's it. I do this, I should get my Black-Scholes option pricing formula. Few things. There's a title which is saying Black-Scholes option valuation, right? So this is what we have given as a formula. These are the parameters we have given: the spot price, strike price, the time to maturity is computed in terms of years. We know the R, risk-free rate of return. We know B, which is the cost of carry, which is same as the risk-free rate of return, and sigma, which is 0.2407. Based on this, this model works out that the option price is 33.67. The call option price is 33.67 as of now. The same logic, if I take it to find out the value of the put option using the same mechanism, I replace it with P. This says the value of the put option in this case is 35.15. Right? Call option premium should be 33.67. The put option premium should be 35.15. So this is what is the information that is typically given out. Right? So we are getting this output, or probably if I just want the price, right? All other things, I mean, this is too much of stuff that it is giving us. If I just want the price, right? The better way to understand what all I can get independently, do a kind of a structure. Right, the same thing, you put a structure on the top of it, which will tell you what are contained as a part of the output, str. Right, you put str and put all these things on the top of it, which will tell you the structure of the output. Now it says you can get at call, you will get what all the parameters, right? You'll say add parameters, you'll get all these parameters. You say add price, you'll get the price of this. So what do I want to do? What I'll try to do is I'll say this, and at the end I put add price. So add price will give me the actual price associated with put option rather than taking the whole summary. So I'm getting the price as 35.15 for the put option. So this is one way I can typically find out directly the value of the call as well as the put option. Of course, this is the F options is a package which really helps us in doing all these calculations and many more calculations more effectively. But at the same time, I can very well take the help of another. I mean, there are a few other packages which can do these jobs for us. So one such kind of a package I can look at is the guide package. So let me try loading that guide package to see what it gives. Okay. So the guide is a kind of an interactive package, right? Even this particular package, if I simply say guide, so it opens up a kind of for derivatives. It's a kind of a GUI for derivatives in R. So a lot of calculations can very well be done, and within that you can look at options. So you could see within this options you can talk about a stock option tree, bond option tree, Black-Scholes. I can very well use this Black-Scholes. Now I give all these things as a part of the interface here, right? Spot price I'll say 1191.2, strike price 1200, risk-free rate of return is 0.0677. The maturity is, I have to give it the maturity period here, R has computed for me, right? The time to maturity, so I'll take it as 0.0904, sigma 0.2407, which is 24.07%, dividend yield is 0, and after that I have to specify whether I'm going for a call or a put. If I go for a call, so this model says the price of a call is this much. Okay, it uses looks like it is using a slightly different formula. So this is the price of the call option, this is the price of the put option. So this is one more way we can typically take the help from the guide, but F options is one interesting package which really gives us a kind of clear computations with respect to the value of the options. So that is what is about the Black-Scholes model. Now let's move towards the next model, which is the Cox-Ross-Rubinstein model, right? You can typically call it as a CRR model, or in short we can also call it as a binomial model. Why a binomial model? One of the prime assumptions of this model is it assumes that the price of any underlying asset, it follows a discrete binomial process. if you try to recollect from the Black-Scholes, the Black-Scholes formula made an assumption that the price of the underlying asset follows a geometric Brownian motion. Whereas this CRR model assumes that the price of the underlying asset follows a discrete binomial process. Mean binomial is either the price can go up or it can go down. At any particular point within the next period, whatever is the size of the period, within the next period, the price can either go up or go down. So it changes in discrete points in time. The price might go up or down in every period. The period could be as long as 10 days, or it could be as big as that, or probably it could be a minute of a second itself. So whatever is the period that we are considering, within that period, the price might either go up or down. And the rate at which the price goes up, the factor, the change of up and down are specified by U and D. U indicates the factor by which the price goes up. D indicates the factor by which the price comes down. But as per this model, the U and D are fixed multipliers. And there is also a kind of linkage between U and D. U is the reciprocal of D and vice versa. So this is what a CRR model assumes. These are all the assumptions of the CRR model. One, it assumes that the price follows a discrete binomial process. Right? The U and D are the multipliers which talk about the upward change and the downward change. And the relationship between both of them is the reciprocal relationship. And it also assumes that the tree is recombining. Recombining means, okay, if it goes up, it has gone up to SU, goes down, it came down to SD. Now from here, again if there is up, it becomes SU squared, but if it comes down, it is SUD. Even from here, if it goes up, it is still SUD only. So this is what we are calling as recombining. The SUD will be similar to S. Will be same as S because it has gone up by U, came down by D. Here also it came down by D and it gone up by U, and we also know that U is 1 by D, so these two will go up. This is similar to S. That is what makes the tree recombining. So the Cox-Rubinstein model typically assumes that your stock price tree is a recombining tree. So these are some of the things that go into the pricing. Now, as a person who is evaluating the price of this particular option using this model, the first thing is I have to decide how many steps we are modeling, right? Which means, okay, now we have 33 days, right? Now we have 33 days for our option maturity. We have 33 days for expiration of our option. Now, how many intervals I want to break this maturity period? Do I want it 1, 2, 3, 10, 30, 50, 100, 500? So that is what is the number of steps. Right? I really need to understand into how many divisions do I need to really break the time to maturity. So this is where I understand what is the length of each step. So the total time to maturity is 33, and depending on the number of periods I want to break it, let's say I want to break it into 33 periods, which means the size of each period is 1. So I'll be able to get the length of each time step through this process. So this is one more thing I need as an input. Then volatility, we already have the information of the volatility of the stock using the daily numbers that are published by the NSE. Based on that, this model computes the U value, the upward multiplication factor, e to the power of sigma root delta t. So because d is nothing but 1 by u, it becomes e to the power of minus sigma into square root of delta t. So that becomes my upward factor and the downward factor. Based on all these things, find out the tree. So make this kind of a tree. That is what goes into the CRR model. Make this kind of a tree. Identify the number of steps. For each step, find out, once you find out your U and D, you will find the prices at the end of each period at each of the steps. So make this complete tree. And at maturity, so let's say this is the maturity period. The possible prices are this, this, this and this. So these are the possible stock prices on the maturity date. Now if this is the stock price, what is the value of the option here? So if it is a call option, it would be the stock price minus the strike price. If it is the put option, it is the strike price minus the stock price. And I have to look at it, compare it with 0. If it is negative, I will take it as 0. If it is positive, I will take that as the value. So for the option value, I will take it as maximum of stock price minus the strike price, or 0 in case of a call option. Maximum of strike price minus the stock price, comma 0 in case of a put option. So I will get the option values here. And based on this, I calculate the expected value of the next two possible. So here if I want to find out the value of the option, I'll find out, okay, these are the two possible values from here. So what is the value of the option here? What is the value of the option here? What is the probability that the value will be this much? What is the probability that the value will be this much? Based on this, I am going to find out the expected value of the option here. And I discount it to this particular period to find out the value of the option at this node. So like this, I keep finding out the value of the option at each of the nodes until I reach here. So I work backwards, find the value of the option at each of the nodes, and whatever the number that comes here will be the final value of the option. Now here one limitation is, or one more important information that we need to know is the probability of the up movement we compute through this mechanism, e to the power of r delta t minus the down factor divided by up factor minus the down factor. Here the probability that the price will go up versus the probability that the price will go down. Here we won't take the real world probability, we take a hypothetical probability which is otherwise called as a risk neutral. I am not getting into the mathematics and all these things of this. So we'll take a risk neutral probability which really helps us to not fight over what discount rate I have to use to find out the present value of this option. I can simply use the risk-free rate of return as a discounting rate to find out the value of the option, because I am using the risk neutral probability to typically find out the expected value. But yes, this is all the conceptual part. Now if I have to put it in R, it's again a straightforward stuff. We have again a straightforward function just like a GBS option function that is present in F options package. Here we have CRR binomial tree option. The CRR binomial tree option directly gives us to compute the binomial tree based call option premium or the put option premium. So let's do for the same example, because we already have the values. The call option premium was around 33 point something and the put option premium was around 35 point something for that example. So the only additional thing that we need to set here is n, which talks about the number of steps of the binomial tree. So we may go with 3 steps, 5 steps, 100 steps, whatever it is. So let's actually go and implement it to see whether there is some kind of a difference. So I'll do the function called CRR binomial tree option. That's the kind of function. So if you want, you can just check what this function typically contains. CRR binomial tree option. So this is very clearly giving us a collection and description of the functions to evaluate options based on the binomial tree option approach. So CRR binomial tree, there are different kinds of binomial trees. We have JR binomial tree, we have Titan binomial tree. Here we are going with the CRR binomial tree option. And there is a general binomial tree option, which is what we will be seeing very soon now. If I have to really go for a binomial tree plot, if I have to use the binomial tree plot, I have to use this function to typically get the price or the premium, not this particular function. So let me first get the premium. CRR binomial tree option. I'll get the CRR binomial tree option. The first thing, I have to give a type flag. So I can give it either as C or P or CE here. CE or PE. If you look at it here, the reason being CE is European call option. PE is European put. Again, we have to understand the difference between these two. So there is an American call versus a European call. In case of European call or European put, the option taker can decide whether to go ahead or to expire the option only on the expiration date. Whereas in case of American option, the option taker can typically decide any time before the maturity of the option. So that is what is the difference between the American and the European. Binomial tree option can be used to evaluate both these kinds of option, whereas in case of a Black-Scholes, we can use this only for European option. Black-Scholes is not applicable for American option. So that's where we were mentioning only C and P in case of Black-Scholes. But in case of binomial tree, we can very well use whether it's a European or an American option. So here I am trying to go with a call European. I have to specify what is the stock price. 1191.2 is the stock price. I can specify the strike price. 1200 is the strike price. I'll go with the time to maturity, which is 33 days out of 365. That is the time to maturity. I can take my risk-free rate of return as 6.77%. I can take my B as 6.77%, which is the cost of carry. Right? I can also take the sigma, all same as the Black-Scholes. 0.2407, which is telling me 24.07%. The only thing I have to specify is N, which is the number of steps in the binomial tree. So this gives me, again, all these things remaining the same, the option premium comes out to 36.37. Right, through this model, the call option is 36.3729 for this European option. And the same thing if I want to do for a put option, I'll do it as at the rate price. Why do I need all this details? I just need the price. So towards the end, I'll put at the rate price. So this gives me, as per this model, the price of the put option is 37.85. So this is what is the Black-Scholes value versus a binomial tree value. Right, let's check from the market what are the values in the market. Right now, if I go with this equity derivatives, going for Infosys, right, as on today, if I'm going for 28th June, the 1200 one, yes, right now the call is traded at 45 and put is at 42.6. That's the market price. Whereas our numbers are showing that the call is 33 or 36 and the put is 35 and 37. right? So there is some small difference existing between the two, but a few things easily working out here. It's showing that the call is slightly lesser compared to the put, whereas it's working the other way in our case. The call is looking slightly, call is lesser compared to the put, whereas from the market it is appearing the other way. But yes, the differences are quite smaller, right? We could see, we will see what could be the kind of a reason, because it has assumed that for the entire period the volatility is constant. Sometime later we'll see that the volatility actually is not constant, and that is one primary reason we'll have these minor differences existing, right? So we can typically look at even plotting. If I want, let's say, the whole plot of the tree, I can use the binomial tree option, not the CRR binomial tree option. If I want to do the plotting, I'll use the binomial tree option. So let me try that. So let's say I'm using bin tree as the name of the variable. So I'll be using binomial tree option function. I'll give all the same parameters. I need to give type flag, which I would be setting it to European call. Right, I have S, which is 1191.2. I have X, which is 1200. I have time to maturity, which is 33 divided by 365. Then I have R, which is 0.0677. I have B, which is 0.0677, and I have N, which is equal to 3, and I have sigma, which is equal to 0.2407. Right, I am taking all these values, and whatever is the binomial tree that got created, I am storing it in a variable called bin tree. Now on the top of it, I can do a binomial tree plot. I'll do a binomial tree plot where I take the bin tree as one of the input. Whatever the binomial tree option has given, the output of that I take into the input, the bin tree. Then I also require, we can see what it gives, what it takes, right? And after that we'll do the plot. So I'll take the binomial tree plot. Look at it, what it gives. Binomial tree plot requires the binomial tree values, dx and dy, numerical values, and offset fine tuning for the placement of the option values in the option tree. So what is the kind of a time frame, right? A fine tuning for the placement of the option values in the option tree. So I can set the dy values or the dx values depending on how much, what is the kind of a spacing they have to provide. So if I set by dy equal to 1, then probably I'll get the, in terms of steps of 1, 1, 1, 1, 2, 3 kind of steps is what I'm going to get. And it would be better depending on the number of branches or number of steps I have created, I can set my dy. So now that we have created 3 steps in the binomial tree, each time period is 1, I can say dy equal to 1. And then I can also give the limit, right? On the x-axis, what could be the values, y-axis, what could be the values, all that stuff. So let me go ahead in terms of doing a binomial tree plot. Let me do a binomial tree plot. So I'll take the bin tree as one of the inputs. Let me set dy equal to 1 because number of steps I have taken as 3. Then I'll take the x label. Okay, what is there on the x-axis? Okay, the time periods, right? So or time steps, whatever it is. I can take the y-axis label. So the y-axis label talks about number of steps, and I can also put the main title also to the graph. The main title, probably I'll put it as a call option tree. What else do I require? X limit also, if you want, I can set it, but yeah, let's see. Yes, so this is what is typically coming out as a part of this binomial tree. So we have set number of steps 0, 1, 2, 3. So it says, okay, this is how the tree got worked out. Right, this is how the call option tree typically got worked out, going with the binomial tree model. And similarly, right, we can very well look out even for the put option tree as well. So we can generate the trees. The only difference is now we change CE to PE, we get the put option tree. Right, probably let me quickly check that out. Right, so I am taking the entire thing to be the same. Instead of CE, I am taking it as PE, and I'll call it as a bin put tree. Then I'll do a binomial tree plot. So here let me call it as a put option tree. Right, all other things remaining the same, I'll take the input as bin put tree. Now this is how my put option thing is typically getting worked out. So that's how we can go ahead in terms of computing the premium associated with a binomial tree model, both for a call as well as a put option. Right? Alright. So the y-axis is showing how many times the underlying price has gone up in total. The down steps are defined in negative terms. Now, the connection between the two models, both of them have lot of assumptions, and both of them are more or less similar in many aspects. A few underlying things, if we manage to hit the option perfectly by holding the appropriate quantity of the underlying asset, this is the way we hit the option. Right, if I want to hedge a particular option, I need to hold the appropriate quantity of the underlying asset. In that case, if the option loses, the underlying asset will gain. If the option gains, the underlying asset will lose. So both of them are neutralizing each other. That is what we call as a risk-free portfolio. That is the basic assumption under which both the models have been developed. Right, I want to hedge the option means I want to hedge the uncertainty associated with the option means I am holding an appropriate quantity of the underlying asset. And in that case, the yield of the risk-free portfolio, which is a risk-free portfolio altogether, so it should be a risk-free rate of return itself. And what should be the appropriate quantity of the underlying asset? So that is typically measured as the partial derivative of the change in the option value with respect to the underlying price, which is otherwise called delta, which we would be seeing under the heading of Greeks. And the value of the derivative is risk neutral. Based on the risk neutral discounting expected value of its future possible value. So at any point in time, if I want to find out the value of the option, it means I'll try to find out what are its future expected values, and I'll take a risk neutral present value of the same by discounting it with the risk-free rate itself. So this mechanism remains the same in both of them. So what are the differences? Why is that the numbers are different in both the models? Now this is where the binomial tree assumes a discrete intervals of time the price changes, whereas the Black-Scholes model assumes that the price changes in continuous point in time. That's the major difference in the assumption between the two. So here we have taken only 3 steps in our binomial tree model, but now if I keep increasing the number of steps, there is a good chance that both the binomial tree model as well as the Black-Scholes model will come closer and closer. Right, that is where I wanted to really showcase by making the number of steps more and more volatile or variable. Right, first let's try creating one function, and then we'll try to see, right, how the binomial tree and the Black-Scholes differ for different values. So let me try first creating one function. So let me take one function. So let me assign it, right. Let me take one typical function, binomial price, bin prices. That's the name of the function I want to take. So I'll take it as function of n. One of the input parameters for this function is n. So here I'll use the CRR binomial tree option, right. N is number of steps. So I'll take the CRR binomial tree option. Everything else I'll set to the same. Flag type or type flag, I'll set it as the European call option. The spot price, I'll check it as 1191.2. The strike price, I'll set it as 1200. The R, I'll set it as 0.0677. The B, I'll set it as 0.0677. Then sigma, I'll set it as 0.2407. And the n, which is the number of periods, I'll set it as a variable n. And for this, I'll get the price. Right? So this is the function I'm going to take. So I have created this function. So for different values of n, right, what does this mean? For different values of n, I'm trying to compute the CRR binomial tree option, because all other things remain the same. Only n is what we give as a part of the variable. So now I'll try to take binomial prices as a variable, wherein I am considering, so I am taking a set of n's. Probably let me take 1 to 100, 1 to 200. So I'll take s apply. So for 1 to, let's say, 200 or 500, right, for all different values of n, means n is 1, n is 2, n is 3, I'll do a bin prices of n. Right, for all 1 to 500, I am trying to find out the bin prices. So it means as the size of the tree, or as the number of steps in the tree is increased from 1 to 500, I want to find out what is the kind of premiums, what is the kind of option premium that is associated with the binomial tree model for the call option European. Okay, in the original function, we did not specify the time. So that's where it's not able to do the computation. So let me redo the function again. Right, I have given all, but I did not give the time in the function. So let me give the time also as a variable. Right, so time is 33 by 365. So let me do the binomial prices as s apply for 1 to 500. Let me give bin prices n. Right, I'll give it as bin prices. Yeah, not n. Now n is not required because n is an input function for all these 1 to 500. So I am getting the binomial prices. Going with the binomial tree model, I want to get the prices. It's taking some time because it has to do the execution for all the 500. Probably we could have reduced the number. So now the binomial prices have been computed. If I really want to look at that, I'll call it as, or I can simply type bin binomial prices to typically see what they are. I got some 500 values. I can look at the structure of the binomial prices to get, here they are numbers, and this is how the values have been changing. Similarly, the Black-Scholes we already have, right? Probably otherwise it's one single value only. So let me call it as BS price. We have GBS option, and within that it is taking type flag is C, the call option. The stock price is 1191.2. The strike price is 1200. The time to maturity is 33 by 365. The R is 0.0677. The B is 0.0677, and sigma is 0.2407. When I take all these numbers, this is what will give me the Black-Scholes price, and at the rate price I'm going to take. So I get this is my BS price. So I have both my binomial price as well as the BS price. Now I can do a plot. I'll do a plot taking X as 1 to 500. Right, on the x-axis I'm taking 1 to 500. On the y-axis I'm taking the binomial prices. Right, I'll take the binomial prices on the y-axis. Then what else do I require? I'll take it as a line graph. So I'll say type is L, where I'll get my line graph. And in the x-axis, probably x label, I'll set it as number of steps or steps. And y-axis label, I'll set it as the prices. Right, option prices or whatever. So these are what I'll show as a part of my binomial tree. So I get this is how my binomial tree is changing depending on n from 0 to 500. And on the top of it I'll try to add my Black-Scholes number. So I'll take, because it's one single, I'll take it as an AB line, where I'm taking it as a horizontal line. The horizontal I'll set it as equivalent to BS price, and probably if required I'll set a different color. Let's set it to red. The color I'll set it equivalent to red. Okay, red is a text. So the color I'm setting it equal to red. So I'm getting this is my Black-Scholes. So you see that the binomial and the Black-Scholes are very much converging. If required, we'll put even a legend to the graph, wherein I'm trying to see where I want the legend first. Have a space on the top right as well as bottom right. So let me set it as bottom right for this case. So I'll say the legend is bottom right, and actually the legend values. What all do I require as the values of the legend? The first thing I require, two values I require. One being the CRR price, and the second one being the Black-Scholes price, BS price. So these are the two things as a part of the legend that I want to be displayed. The color wise, the first color, the CRR price is black, whereas the Black-Scholes price is red. So I'll take the color, and even the PCH, probably I'll give the coloring kind of stuff, the one that is highlighted in black. So I'll give the PCH as 19 for both of them. So this is where I can do the plotting, and I'll get, okay, something in CRR is black, Black-Scholes is red. So this is how I'm getting my Black-Scholes converging, or the binomial tree option price converging to that of a Black-Scholes option price. This is one more thing that we have demonstrated in R, which is easier to demonstrate because I have made a simple function wherein I have changed the number of steps. I've created a function for Black-Scholes price based, binomial tree price based on the number of steps, and based on which we have taken the steps from 1 to 500 and typically computed the values and then the plotting for the same. So this is how we can compare the binomial tree model with the Black-Scholes model, and at the end, for larger values of number of steps, as the number of steps increases, we see that the binomial tree model is converging towards the Black-Scholes model. Right? Now, the next part that we are looking at here is the Greeks. Greeks actually talk about the sensitivity, right? How the option premium changes with various variables. What is the sensitivity of the option price? So here, why do we really need to understand the Greeks? First, they are majorly helping us in trying to understand the different risk types an option might have. And that is very, very important for all of us who are trading in the derivatives sector, who are working in the option sector. All the market participants typically need to understand what are the different kinds of risks the options are exposed to, how the option premium changes with respect to different kinds of risks, right? So the measurement of Greeks is primarily helping us in terms of understanding or computing different types of risks, which talks about the sensitivity of the option to different factors. So here also we have a direct function called GBS Greeks. That is the beauty of F options package. The Greeks computed based on the Black-Scholes formula, right? So we can very well talk about the option Greeks. So let's say let's talk about GBS Greeks to see what it contains. Right, let's look at the function or the Excel, or the R function called GBS Greek, which typically contains a collection and description of the functions to evaluate plain vanilla option. Generalized Black-Scholes, the same Black-Scholes option typically contains the GBS Greeks also. Right, we have usage wise, we have GBS Greeks. So within GBS we have so many set of options. So we have GBS Greeks where we are doing the selection, type flag, all these things. So we'll try to find out what all we want. So we'll use the GBS Greek. Let's create as a function. We have different types of Greeks. First of all, to understand, we have a delta, which talks about the change in the premium, option premium per 1 unit change in the underlying price. So the gamma talks about the sensitivity of delta, the change of delta for 1 unit change in the underlying price. How does the option premium change with respect to the time to maturity is measured by theta. When everything else remains the same, if the risk-free rate of return changes by 1 unit, by how much will the option premium change? That is what is measured by rho. And when the volatility changes by 1 unit, by how much extent does the option premium change? That is what is measured by vega, V. So these are the different kinds of sensitivities associated with the options. So these are the 5 kinds of options I can measure. So the delta, the gamma, the vega, the theta and the rho. Right, so we'll create one function. Right, so we'll create one function. So we'll assign it to the Greeks. Greeks is the name of the function, or probably we'll call it option Greeks. Option Greeks is the name of the function. So we'll create a function by taking the input name. Right, we'll take the input name as Greek, so it could be either delta, gamma, whatever it is. So I'll create a function which takes an input as Greek. Now, so for this I'll use the function name called GBS Greek. Some of the inputs of GBS Greeks, first I require the selection. So whether it is gamma, delta, whatever it is. So that is what I am calling as selection. So that I will pass as a variable. So let me take it as Greek itself. Then I require the type flag based on what I am computing. Is it for a call option or a put option? So this is where I will say, because this Black-Scholes I will give it as C, not CE, because it's a call option. Then I require the stock price 1191.2. Then I have the strike price 1200. Then I have the time to maturity, which is 33 by 365. Then I also have the R as 0.0677, the B as 0.0677 and the sigma as 0.2407. Right, this is what is doing the GBS Greeks. So I'll close this function. So this function is computing the Greeks depending on whether I want gamma, delta, whatever it is. So that's where I'll try to apply. So I'll do apply. What are the different inputs I need to apply? First I want to find out the delta. Then so I have to take a C function here because I am taking 5 independent values. So I require delta, I require gamma, I require rho, I require vega and I require theta. Right, these are the 5 different values I require, and for all these things I want to apply this function called option Greeks. So I get the delta for this option is 5 into 10 to the power of minus 1. So it's almost 0.5. So for this case I am getting the delta as 0.5 approximately. The gamma is 4.62 into 10 to the power of minus 3. So it comes out as 0.0046. This is gamma. The theta is working as minus 2.28 into 10 to the power of 2. So it's coming out as minus 228 point something. The rho is working as 5.1 into 10 to the power of 1. So it is coming out to 51.62 is the value of rho. And vega is coming out 1.42 into 10 to the power of 2, which works out to 142.86. So these are the values of each one of them that I am getting here. Right? So now we have the delta, all these things measured. Now it's very important for us to analyze how the Greek changes if some market parameter changes. For example, I want to really understand if the time to maturity changes, right, one day, for tomorrow, day after, the day after. So as we are coming closer and closer to maturity, what is happening to the delta? So I really want, I want to find out the delta, but as the time to maturity is changing, I really want to find out how the delta keeps changing, right? So I want to really find out for different kinds of stock prices how the delta keeps changing with time. So I am taking two variables now, right? I am taking two variables. I want to see how the delta keeps changing with time, right? How the delta keeps changing with time. So first thing, let me create a delta. Let me create one function with respect to both time as well as, so let me call it different times, right? So time delta relation, I'll call one function, so wherein I am giving the input as the timing. The time is what I am giving as an input to this function. So here I'll do a supply wherein I am taking different prices. So Infosys is somewhere around 1100. So let me take it, let's say from 500 to 1500 for all the prices. I want to apply one more function, which is function of the prices. So I'll take function of S. So here the input for me, so there are two functions, a function within a function, right? So here I'll use the GBS Greeks. I'll see how the Greeks are changing. And what are the inputs do I require here? Selection. I'll look at only the delta, how the delta is changing. So I really need only the delta. Type flag, let me do it only for call option. So I'll call it C. Then all others. Stock price, here I'll bring it from this variable S. So stock price is this variable S. So it will apply the stock price for all of the variables. Then I also require, right? Otherwise I could have created a stock price. Okay. So I am getting a stock price of X. The strike price as 1200. The time to maturity, I'll take it as T. I'll give all different possibilities from 33, right, from 33 to almost 1 day to maturity. So let me take all the different possibilities. So that's where I'll give T as the variable there, and let me take R as 0.0677, B as 0.0677, and sigma as 0.2407 for the same numerical, right? I'm taking a GBS. So this function is ended, and even the function T is ended. Okay, I can't close it, so I have to close one bracket and then follow it up with this bracket. Let me write the function again. So this function is closed. Then sapply I need to close. Then I am closing the other function. Yes. So my function T is ready with me, right? So I'll do an sapply now. So this sapply for different T's I want. So what are my T's? I'll take it as 1 by So I'll take it as a sequence. In that sequence, I'll set it as 1 by 365. So I'll set from equal to 1 by 365, 2 equal to 33 by 365, and by, I'll put it as 1 by 365. So this is the kind of a sequence. So for every day I am trying to find out the S supply. So I am setting this kind of a sequence, and on this sequence I am applying my function time delta. And let's say this entire S supply, let me give a name called deltas. Okay, there are different deltas that are computed. So if I look at deltas, I get all these possible values of delta. Right, I am getting all these possible values of delta. Look at this. So there are 31 different values and over 1000 possible stock prices. So we are getting 1000. So you look at the dim of deltas, you will get, so there are 1001 rows and there are 33 columns, because 33 different dates and 1001 different possible stock prices, because I have taken it from 5000 to 15,000. So this is what, if possible, I can do a plot. Right, plotting wise I can do right from 500 to 1500. Now I have the numbers. Now delta I take, probably for the first one let me take one delta. So I'll take the deltas of all the rows and first column, which is for 1 by 365, right, and probably on the top of it we'll add some more. So type I'll set it to L. So this is the plot of delta for different stock prices when the time to maturity is 1 day. Let me do the same, wherein I'll add a few more lines to the same plot. Right, I'll do 500 to 1500 again, but this time let me take the deltas. Let's say all the rows and somewhere midway, 15th column. So which is 15 days to maturity. Put it with a different color. Let me put it with a blue color. So I could see that now in this case the delta is changing. After a certain period we are seeing the delta is slightly higher, right, and when it comes towards the maturities, the delta is going slightly lesser. As the value is increasing, as the stock price has increased, you are seeing that the deltas are much lesser. The same logic if you want to put, let's say if it is 30 days to maturity or 33 days to maturity, and plot it with some other color, red, I could see it's even more. So what you are seeing is, as the stock price is lesser than the strike, right, a few things, as the stock price is lesser than the strike, we are seeing that the deltas are much higher if the time to maturity is more, but the values are much lesser if the time to maturity is less. But on the other side, if the stock price is much higher than the strike price, the delta is close to 1 if the time to maturity is very less, and because there is either a chance, if it is just 1 day to maturity, either it would be executed or it would not be executed. So the chances are very on the either side. If the price is much lesser, the chance of exercising the option is 0. If the price is much higher than the strike price, the chances of exercising the option are much higher. So the delta will be either 1 or 0. But as the time to maturity is increasing, as there are some more days to maturity, we see a different values of deltas coming up. So this kind of relationships, understanding these kind of relationships is very, very important for us, because it helps us to make the planning and allocations more and more effectively. So this is one more thing which I wanted to demonstrate here. Some code of that is being specified here as well. Then one more important topic that I want to cover in this session is the concept of implied volatility. Here we have already seen in the Black-Scholes model, one of the major assumptions of the model is it assumes that the volatility is constant for the asset throughout the entire period of the validity of the option. But in reality, the volatility of the underlying keeps changing quite heavily. So that's a major challenge. Volatility is a very, very complicated parameter. If you look at in the Black-Scholes formula, stock price seen in the market, strike price known, risk-free rate observed from the treasury bill rates. Similarly, time to maturity known. Sigma is the only thing that is difficult to measure. You can't even measure what is sigma. It's not a directly observable kind of a quantity. That is what makes the understanding of the volatility more and more confusing and complicated. So generally what is used is the Black-Scholes formula. It is used in an indirect way to actually estimate the volatility. So what I do is I take the market price, the market based volatility I take, right? The market price, sorry, the market based Black-Scholes price, the market based price I take as the Black-Scholes price, equate this to the Black-Scholes formula. All these are known, only this is unknown. So I'll estimate this by equating what comes by the Black-Scholes price equal to the market price. The volatility that is really computed from this process is called as the implied volatility. So here we are first, instead of computing the price of option, we take the price of the option from the market. We take all the other parameters as it is. So this will become the unknown for us. So we try to go for searching this standard deviation by equating the Black-Scholes price equal to the market price. So that is what is a measure. So let's do that. Let's do one thing. Let me get, these are the different, right? These are the different stock prices, strike prices. So let me take this data into an Excel sheet, right? Let's try something. Let me take this data into an Excel sheet, a fresh sheet. I'll take it. Okay. Only for those which have, right, let me take even these. Okay, I'll consider only those securities for which the trading has actually happened. So let me take the data only from here. Right, these are some of the securities, or even if I copy this entire thing, let me take the data of this. Okay, let me take this data. Right, so let me do the, let me remove all kinds of formattings, or let's keep it. So wherever the trading has not occurred, let me remove them. So for simplicity purpose, right? I'm removing this because at least one trade does not exist. So even for this one call is not exist, so let me remove it. Even for this, or yeah, the last traded price, even here it does not exist, so let me remove. So these are the different calls for which some kind of a trading has occurred. The same thing either I can do for calls or for puts, whatever it is. So in this case I have taken the calls. So let me take out all these other things also. Doesn't matter. I don't want the puts here. I'm looking at the calls, right? And all these things also. Let me remove the hyperlinks across, right? And a small formatting. All right. So this let me save as, I don't need now this sheet. So let me delete this. I will save this as CSV, right? So let me do this in my documents, or probably let me take my desktop. Within this desktop, let me call it as np options dot csv. So we'll call it as a CSV file, right? npoptions.csv is the name of the file. So let me get that into R, right? So we will try to see how the implied volatility keeps changing. So let me take the Infosys data. So I'll take read.csv, go to the desktop. On the desktop, I have this npoptions.csv. So I'm simply getting that data into R, right? npoptions.csv. So in case of Windows, it requires double slash. Okay, I need to close the bracket. So inp is the data that I have got. Then we'll create a volatilities function. If you look at the PPT here, for computing the volatilities, we have a function called GBS volatility. Right, so let's see what is this GBS volatility. Again, this is the same group, GBS star. So I can get the GBS volatility through this same usage. So we'll create a function again to get the volatility, right? So we'll create a function. So volatility, VOL is the name of the function that I'm trying to create. Function of volatility. Volat. We'll say it's a function of volat. So the volat is my variable. I'll take the function as GBS volatility. One of the things that I require is the price. So I'll take the price from the inp. So I'll take the ask price. So let me see what is the name. So it's better that before I create the function, I know the names, right? I think it's ask dot price. Or before we do the function, let's do the names of np, so that we'll use the function headings. Okay, it is ask and ask.1. Okay, ask is the price, ask.1 is the quantity, so I'll take it as ask, right? So I'll create a function called volatility, which is a function of volat, which takes the first thing. I'll use GBS volatility as the name of the function, right? The price, I'll take it equivalent to the ask price. So I'll say np dollar ask. For the np data frame, I'm taking the ask. That's the name of, that's the price that I'm supplying. So for each one I have to take the price. So that's where I'll take it as the price associated with that volatility. Right, I'll take the volatility number. Right, so I'll take the sequence, so that's where I'll call it as volat itself. Right, I'll take whatever is the as corresponding to that particular volatility. Then I'll take the type flag as the name of the call option. So there's a type flag, I'll set it to call. Then the stock price, I'm setting it to 1191.2. The strike price, I'll pull it from the INFI dollar. What is the strike price? Strike dot price. Right, I'll take it as strike dot price. Again, this is also associated with that particular volatility, so that's where I'm saying volat. And what are the other things? I have to take my time to maturity. Time to maturity is 33 by 365. I have my R value as 0.0677. I have the B value again as 0.0677. And I also have my sigma value. No, sigma is something that I have to compute. So this is what is being computed by GBS volatility. So let me so whatever is the input that I am giving, so it's a function of volatility. I am getting the INFI ask price, I am getting the INFI strike price. Right, so this is where now I can compute the volatilities associated with each of the strike prices. So that's where I'm putting it as a supply. For different volatilities I'll take, so that's where I'll take it as sequence along. I'll take all the values from the volatilities list. Right, I'll take all the values from the volatilities list. So I'll take INFI strike dot price. So I'm getting all the sequence along the INFI strike price, and on the top of it I'm applying this function called vol. Vol is the function that I'm applying on the top of it. Sequence along, sorry, volatilities is the name that I'm going to give. Volatilities is the name that I'm going to give. S apply sequence along this. What has happened? Okay, is there some kind of a problem with let me check what is str of INFI. Okay, all are coming out as factors, right? Ask has come out as factor, it's not numbers, so this is where the problem cropped up. Right, strike price is numbers, but all these are coming out as factors. Okay, let me just change the format of each one of them. Let me just make them explicit numbers. Right, let me just make them explicit numbers. Now let me try doing the same task again. So first let me read the INFI. right? Now let me first quickly check what is the structure of NP. Now there are still factors. So now that I require the ask price and the strike. Strike is still a number, but it has NA. Why it has NA? Okay, this is the problem. So let me remove the second row altogether. Right, now let me get it. Right, it is having two rows, so that's where the problem came up. So now let me try str in fee. Yeah, now it is showing at least for bid 1. Ask, it is still showing factors. Okay, because these are looking like blanks, right? So let me remove these blanks as well. But I don't have the ask prices for each one of them. So let me remove even this data as well, so that we can understand the concept first clearly. Right, so let me make this as blanks. So let us use this data to try to understand whether things are falling in line. Okay, so now let me try str in p to see what is the type. Yes, now all these are coming out to be numbers. So the data cleaning is more important. Now the data came out as numbers. So the function, anyhow we have created the function vol. So what I want to do is I want to apply that function on the various strike prices. Yes. Now when I apply this function volatilities, right, vol is the name of the function I want to apply for all the strike prices. Okay. Yeah, volatilities I have applied for all the strike prices. So if I really want to check what are the volatilities, I can check the volatilities. So it is like 38.93 and it has come up to 33. So if required, I want to do a simple plot of volatilities to see how the volatilities are changing. So on the y-axis, I'll take my volatilities, and on the x-axis, I'll take my strike rates. Right, I can very well take my strike rate. So I'll say in p dot strike dot price. So I could see here the strike prices on the x-axis and volatilities on the y. Here the volatilities are much higher. It's coming down. It has come to the minimum and again it started going up. So all I could see is for different strikes, the volatilities are different in the market. And if I do this plotting for various kinds of for various strike prices, I should get a kind of a curve like this, which is what theoretically we call as a volatility smile. The implied volatility changes with respect to the strike prices, and that is what we are calling as a volatility smile. So these are the different kinds of aspects that we should look at when we are working with options. So as a part of this session, I thought I should cover all these things. We have looked at in depth about the Black-Scholes model, how we implement the Black-Scholes model in R. Then talked about the Cox-Ross-Rubinstein model, which is same as binomial tree model. Tried finding out what is the kind of relationship that is existing between the models. Then we spent some time in terms of looking at the Greeks and what is the kind of relationship that exists between different Greeks. How do we really get into that kind of a mechanism? Then we have also looked at implied volatility and how implied volatility changes with the strike prices. This is one assumption that the Black-Scholes model had really made, but what we have really seen in reality is the implied volatility keeps changing. So all these things, a good understanding is very much required for people working in the derivatives market, especially the options market. If you have any further queries regarding this topic, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.